Hey everybody, Eric Mitchell with Client Direct Mortgage here with Patrick, our love rep at NexBank. He's going to go over products, access, how to look at pricing, etc. Without further ado, Patrick, let's see what you got.
Thank you for the introduction. I appreciate it. I'm a national sales rep for NexBank. I've been here 10 years. The way to think of NexBank is we are a private banking institution. With that, we bring private banking into the mortgage industry. We're not your traditional brick and mortar bank. Being a FDIC bank, that allows us to offer a wide variety of products, including portfolio products. So what we'll do is dive into each of these. Under NexBank, we have a portfolio, we call it Mortgage Connect. So if you think of this as a big umbrella, it's Mortgage Connect. Underneath that, you have full doc offerings and you have reduced doc offerings. We give you a variety of terms. We have a 1-6, 3-6, 5-5, 5-6, 7-6, 10-6, and a 6-6 arm. We also have 15-year fixed and 30-year. The beauty of the full doc is it goes from 200,000 to 2.5 million, which I'll dive into a little bit later as we delve into the products. This is a great alternative for second homes and non-owner occ. The LLPAs are either non-existent or much lower than your standard conventional. In this product under full doc, max LTV 80%, minimum FICO 680, and we use DU or LP to make the credit decision. Thing I like to say is there's only a couple overlays, which max acreage is 40 acres on our portfolio product full doc. If you get an appraisal waiver, we do require an appraisal. And the max DTI is limited to 45%. So if you've got a loan amount 200,000 to 2.5 million, especially second home or investment, you would always want to compare NexBank. We get a lot of new customers just because we don't have the LLPAs on second home. Under that, we also have a non-QM, which still Mortgage Connect under this umbrella, and we call it Mortgage Connect non-QM reduced stock. 80% LTV is the max, 700 FICO, and we give you three different abilities to repay. So you can choose assets, bank statements, or DSCR. Does allow cash out to 80% on the primary and cash out to 75% for non-owner occ and second home. And we'll dig a little bit deeper into the non-QM to kind of break down the assets, the bank statement, and the DSCR so you can kind of get a handle of what you're looking at with NexBank. The beauty of our portfolio products is there is no prepay penalty. You do have the 6-month EPO, but as far as a borrower prepay, there's no option for that. We do tighten up a little bit more than our competitors on the non-QM space, but you get a market leading rate with that. Under agency, we are a Fannie Freddie Direct. We have FHA, we have VA. Something that stands out is our Flash Pack. NexBank, we take a standard conventional product and we tailor it to something that gives us a little bit better price, but gives our underwriters an easy underwrite. So basically, you're giving us a cookie cutter loan, I'm giving you a much better price. Borrower needs to be W-2, fixed income, self-employed is ineligible. They can use retirement income. That's allowed. Essentially, we are looking for a loan with no tax returns. They can own one other piece of property at time of close as long as you're hitting them with the full debt. And for this product, it's primary residence only, purchase or rate and term, 640 minimum FICO.
Let me ask you a question here, Patrick. So when you say no tax returns, that's if the AUS findings don't request tax returns, or are you saying there's just no tax returns?
Basically, I can't have a self-employed borrower, or I can't have anything that requires tax returns to verify income. So I'm looking for a cookie cutter.
So long as the AUS findings don't request the tax returns, there's no tax return. If the AUS findings request tax returns, even if they're W-2'd?
We would have to tier out to a standard conventional.
Okay, got it.
Yeah, so I'd probably say, I was looking at the numbers from the locks yesterday, about 16% of what was coming in were fast pass eligible. People are, have got a standard W-2 bar. They're buying a primary. Could be a first-time home buyer as well. You never know. Depending on what their income is, if you can't fit into Home Ready or Home Possible, you can have an agency fast pass. That is still 95% first-time home buyer, W-2, salary. Doesn't matter to us.
So if you're a loan officer and you run the AUS findings and it's not requesting tax returns, this is you should be looking at the flash pass to just
correct. Get
push it
probably
through real quick. Okay.
Yeah. We do offer Home Ready and Home Possible, and with NexBank, you're able to flip flop between them. So let's say you're going Home Ready, but there's something that your borrower doesn't fit or is not as favorable. You can always go Home Possible and resubmit LP. Pricing is different, but you don't have to go back to the beginning. You can basically re-upload new findings, finalize them to us, and let us know that you're changing it from DU Home Ready to Home Possible. We do participate in the 2,500 VLIP credit. So if you have a borrower that is first-time home buyer under 50% AMI, they are eligible for that credit. And one thing to think that a lot of people forget about Home Ready and Home Possible, it's been sitting with us for so long, is it is allowed for rate and term refinance. So if you have a borrower that is doing a rate and term refi, they're under the 80% AMI, it wipes out the LLPAs, just like a purchase. So always read your findings. If you run DU, it will let you know if it is Home Ready eligible. And I would highly suggest rerunning it. Because, I mean, LLPAs can get very costly, especially depending on the borrower's FICO score. So having the ability to wipe those out is great. We do offer your standard FHA and VA, pretty vanilla, nothing out of the norm there for us. And I'll
Okay,
dive a little.
and your pricing is in Meridian Links. Our loan officers, if you're looking at your mini core banked pricing, NexBank, you're pushing all this through Meridian Link pricing engine, correct?
And that is correct.
Great, thank you.
Yep. And your borrowers, I mean, your loan officers can request logins through our customer service at NexBank, and we've got it all profiled out for your team.
Okay.
So W-2, this basically just showing you in a bigger format of what we discussed. W-2 fixed income, 1 unit primary, better pricing than agency. Simpler product, streamline. If we ever got super busy, we would push FastPass to a faster underwrite. In today's world with NexBank, we are very well staffed, very well positioned. We're 1 day on underwrite across all our products currently. So at this point, the only main differentiation of Flash Pass versus a standard conforming is really the price differential. Usually runs about 10 to 15 bips. And we'll jump over to the Mortgage Connect. This is back to the umbrella, full doc and reduced doc, 200,000 to 2.5 million. And the no LLPAs on the second home. That is the biggest thing. If you price out a Mortgage Connect against a standard agency, let's say it's 200,000 to your conforming limits, we are probably about 5/8 better in rate than conventional, where conventional, you're probably still paying a discount to get a second home at 80%.
Yeah, on second homes and investor properties, loan officers should always be comparing, portfolio and non-QM pricing for sure.
Absolutely. In investment properties, the LLPA, if it's above 70%, is 3/4 on our portfolio, full doc. If it's under 70, it's 3/8. So that's really your sweet spot is if you have let's say a self-employed borrower and they run investment properties, they might not have an 800 score. They might be in that 700, 720, where you could get beat up a little bit on conforming. I mean, they're already going to hit you for the LLPAs, but we don't have a FICO adjuster. So a full doc 680 plus FICO is getting the same rate as a 800 FICO on this product. So it's just something to look at. And investors love the ARMs. You might have investors looking for short-term financing. Some will do the 6-month ARM, which is a ridiculously low rate, but it will adjust adversely on them very quickly. So we've seen a trend going towards the 1 and 3 year, which is a big splash. I mean, investor getting a rate, an ARM rate in the 6s, you're not going to find that out there in the conventional world.
Okay.
All right. We'll jump into the reduced stock part of this umbrella. So under this, we have 3 different abilities to repay: bank statement, debt service coverage, and assets. And this also goes 200,000 to 2.5 million. We will make exceptions on loan amount higher than 2.5 million case by case, but we will not make an exception under 200,000. And the LLPAs are the same on the reduced stock. That's just giving you just a picture of the bank statement, DSCR, and asset. So we'll dive into each of those a little bit more granular. So under here, we have the bank statement. We do 12 to 24 months bank statements. What we're looking for with our bank statement, the way we like to structure it is we will ask for 12 months bank statements. And if the income is stable within those 12 months, we will go no further. But if you have a borrower that's got seasonal income or inflow, then we would go back and ask for 24 months. Perfect example, maybe someone putting in a pool up in the Northeast, can't build pools in the winter, much more difficult. So that's what that program. So we'll look at 12, we'll go to 24 if needed. 50% expense ratio, you can get a CPA letter if to attest that the expenses are less. And on this, you can also blend incomes. You could have borrower number one that is self-employed or 1099 running bank statements, but co-borrower is W-2, and that is allowed. And you could also bring in someone else's Social Security income. The key is just no tax returns, no tax documents, no tax returns, period, for the co-borrower. We'll break it out into our guidelines, but you can bring in the W-2s and pay stubs.
Okay,
we do allow gift funds as well. Go ahead.
No, I just said good to know.
Oh, good. Yeah, gift funds we do allow. Greater than 70%, we do require the borrower to have 5% of their own fund. And gift funds are allowed to meet the reserve requirements on primary transactions. It is eligible on primary and second home and investment, but we break it down differently. And this is what I was referring to: secondary income permitted, such as Social Security, rental, non-employment wages. We will jump over to DSCR, which I'm pretty sure everyone's familiar with. One thing to note is on purchases, investment purchases, NexBank does look for long-term rent income. Keep that in mind. Short-term rental income is permitted on refinances if they're through a management company. That's a big question we get. On this purchaser rate and term, again, we will go 200,000 is the minimum. We'll go up to 1 million at 80%, 700 FICO, 1 DSCR ratio. We will drop down to 75% LTV if the borrower has a 0.75 DSCR ratio. Right. For your higher loan amounts, 200,000 to 1.5 million, we'll do still 1 to 4 units, 75%, minimum FICO 700. In the same 200,000 to 2 million, we're still 700 FICO, but the 1 ratio. So this is your sweet spot, is the 0.75 at 75% for purchaser rate and term. And then cash out, we'll allow up to 75%, 1 to 4 unit, 700 FICO, 1 DSCR ratio. And I'll be the first to tell you, our reserve requirements on DSCR are pretty hefty. They can go anywhere from 12 to 18 months. So what we are looking for is a more well-qualified borrower, but in return, you're getting a market-leading rate with no prepays. So we're not trying to throw a cast net and get everyone out there. The secret behind all this is NexBank manages warehouse lines, and some of those are competitors that offer non-QM, so we get to see the whole spectrum of what is being offered out there in the market. And that allows us to custom tailor what we're looking for. The biggest thing on ours is you can't be a first-time home buyer and you cannot be a first-time investor. And what we mean by first-time investor is lifetime. It doesn't have to be within the past 3 years. Just at some point in history, we need to be able to document that they've got a 12-month history of owning and managing investment property, or if they own a commercial building and can document that they manage that, renting it out, that would be acceptable as well. And a lot of people say, how do you document that? Well, you can document it with leases. They don't have the leases. You could possibly go back to the CPA. What we're trying not to do is get a Schedule E in here. We really don't want any tax returns unless that Schedule E is 10 years old, way back in time. But really, we leave the gate open, show us what you can provide, that they have a management history. All right. Currently, they do need to close in their personal name. We are working to allow them to close in an LLC. They can move it into an LLC sometime after close. We don't want to do it immediately. We want to at least get it set up and serviced, but that is allowed. So if we are doing a purchase, 100% of the lesser of the current rent or market rent determined by the appraiser, if rented current rent per lease, if vacant, use 100% of the 1007. And then for your refinances, if rented current market required or 1007, current is least amount is greater than the appraiser's opinion of the current market rent, the lease amount may be utilized provided the lease will continue for at least 6 months after the note date and the most recent 2 months of rent due can be documented.
So bank
Now
statements.
for
Bank statements to document.
yes, document. That works. Subject property is short-term rental. We'll use the lesser of 100% of the current market rent per the appraiser's rent analysis on the 1007 or 75% of the 12-month average where the borrower utilized a property management company, such as Airbnb, VRBO. And the reason that we're a little bit stricter on the short-term rental is we've seen markets starting to contract. I'm based in Georgia, and North Georgia, there's mountain communities where they're actually putting up and limiting the number of short-term rentals being allowed to put on the market, where they're even basically doing a lottery where you have to sign in, get a ticket, and if you don't have a ticket and you're hitting that max, you can never turn it into a short-term rental like a VRBO. It would have to be something along a 2 week to 30-day rental. So, at any point in time, a community can say we no longer want VRBO or Airbnb, and if they do that, well, we've qualified a bar based on rents on a short-term level that would be substantially higher than if it were a long-term lease. So that's the reasoning there.
Mhm.
The third ability to repay, this is still under Mortgage Connect reduced stock, and this is one of my favorites, is assets is an ability to repay. It's not asset depletion or distribution, anything on that. The short and sweet is it goes 200,000 to 2.5 million. And I would jump down here for the qualifying method. So essentially, if your borrower is buying a primary residence, has no other properties, if they have 125% of the outstanding mortgage debt, including all other REOs, so if we're just looking at a primary and they have no other REOs, 125% of that mortgage debt post-close, they get a loan. So if you have a borrower that might have retired, no longer has income, recently sold a business, no longer has income, but is sitting on tons of assets, this is the program for them. And we
Okay,
do a lot of
so let's say they want a $500,000 mortgage, but they have a $650,000 cash sitting in the bank. You're good.
yeah, yep, post closing.
Post close, right?
Yeah.
So they need
Now, if they have
they need the down payment plus the post close.
correct. And
Got
we
it.
do provide a calculator that you can input all the borrower's assets, and it'll tell you if it meets method one, simplified method, or traditional method. So the simplified method is more, hey, they can't meet the 125%, but let's try this other method. So this one is 120% of the proposed mortgages on the subject property plus 30% of all outstanding debt balances in which the borrower is obligated. If they don't meet that one, you can do more of a traditional method, 100% of the subject property plus 60 months of debt service, monthly payments, plus 60 months of the net rental losses on other REOs. In our guidelines, we give you examples of each of these. So it can kind of help you wrap your head around it.
Yep.
Far as eligible funds, 100% of depository accounts, 80% of securities, 80% of stocks, bonds, mutual funds. Now, this the beauty is you don't have to be a retirement age to use this product. So 70% invested amount when the borrower is under 59 and a half years old, and 80% when they're over it. And a lot of people forget about life insurance policies, cash value. We do allow that 100%. And there's a lot of older people out there, they definitely have cash value life insurance policies. See them all the time. So if you're looking for extra assets, that's one place to reach out to your bar and just ask them if they possibly have it. So we had one gentleman, he recently sold a fencing company, $9.5 million. No longer had income, had the assets. He wanted a $3.5 million loan amount. I think it was about 60% LTV. He got a loan, got an exception, and got a loan. But this is one of my favorite to talk about, especially if you are friends with money managers. They do not want those assets leaving their accounts. So that's where this product comes in.
Besides their
And it,
commissions.
yeah,
Yes.
yeah, they make a good amount. I've got a couple buddies. Yeah, they're making money off your money. Yeah, that's in a nutshell the portfolio products and just the flash pass being outside of a standard conventional.
Okay.
With
And
NexBank, mhm,
can you also put up your contact information just so people know how to
yes,
reach
sir.
you?
Yeah, I will put it up right here.
There we go.
And
So there's your
one
phone
thing
number and your email.
phone number is 404-234-6738.
I
And
don't
I
see your
will,
email. I don't see your
yeah,
email
I'll
there.
put it up there. Sorry about that. We'll put it in my signature. There we go.
There you go.
One thing to note is NexBank offers escrow holdbacks. Just you're seeing a flash by here. A lot of the newer generation, the mortgage company probably might not be that familiar with an escrow holdback is. So if you have a borrower that enters into a contract, to purchase a home, they haven't done the inspection, they haven't done the appraisal, things bubble up, and then that appraisal is subject to. And it could be for minor stuff, but the seller might say, I don't care. I don't want to fix them because I don't have an idea that you're actually going to close on one. In some of these items, you can actually do a escrow holdback. Let's say the water heater needs replaced. It's leaking or it needs to be replaced. Someone pointed out as a deficiency, or there's wood rot that needs to be addressed. Maybe a window is leaking, needs to be replaced, as long as there's no water ingress on it. You can get receipts or basically estimates for the cost of the repair, and we will hold back 150% of that repair amount. And after close, the borrower can go get them repaired. And once that's completed, you will send us the invoices stating that they're repaired. You'll show us that it's been done satisfactory to the borrowers.
Does an appraiser need to go out and take pictures, or you'll take photographs from the borrower?
It really depends where it's found. So if it's in the contract, but the appraiser never addresses it, that's one thing, is something in the contract. But if it's something as a deficiency that the appraiser's pushing out, then the appraiser will have to go back out. Yeah.
Okay.
But this one, escrow holdbacks save a lot of deals. They really do. And if you place a loan with a lender and then you get the contract, then you get the appraisal, and you start getting all these pieces and finding out there's an issue, well, you've already locked it in with a lender that might not have escrow holdbacks. And if the market moved on you, now you're in trouble, or at least your borrower's getting hit. We'll do escrow holdbacks. We stay away from roof, we stay away from foundation, we stay away from safety. But if you have new construction and in that purchase agreement is the builder's going to put a pool in, well, we'll do an escrow holdback for a pool. Do it all the time. Or another thing is during COVID, supply chain issues. The house might be built, but they can't get the fence, or landscaping is not signed off on. So those are the things we can kind of put our heads around and see if we can do an escrow holdback. So it makes everyone's life easy, keeps the loan moving.
Wonderful.
Yep.
Patrick, is
And
there
just
anything else you want to cover that we haven't covered yet?
home ready, home possible. We give an extra quarter in price. FICO's above 720, conventional fixed, get an extra 8.
Is that all in
And
your
you'll see
LLPAs when somebody runs it in Meridian Link?
it'll all be built in there.
Okay.
Yeah. And of course, if someone runs a first time home buyer with an AMI under 100%, income under 100%, it'll wipe out all the LLPAs the same as home ready, home possible. And we
Great.
do incentivize loan amounts less than 275, and we also further incentivize above 325. I would say we get the Coronas reports. We're generally in the top 3 or 4.
Great.
You have any questions for me?
No, man, I appreciate your time. Thank you to everybody watching this video. Reach out to us anytime if you have questions. There's Patrick's information and appreciate you.